This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Jam-packed week from the jobs report to the first read on second quarter economic growth. The data will flow fast and furious. But will it change anything for Janet Yellen and the Fed? Different directions, a new prognosis for two of the nation's biggest entitlement programs, Medicare and Social Security. Merger Monday, $12 billion in deals helping to lift spirits on Wall Street. We'll tell you who was in a buying mood and why. All that and more tonight on Nightly Business Report for Monday, July 28th. Good evening, everyone, and welcome. I'm Tyler Matheson. Susie Gehring has the night off. Well, the week started with a hint of optimism thanks to a duo of deals. But there was a greater hint of caution as investors paused ahead of a number of high-profile economic reports this week, corporate earnings, and underlying concerns about geopolitical risk. Today, the White House says it expects the European Union to impose new sanctions this week against Russia, and that the U.S. will impose additional measures as well. And deal news, which saw former rivals Zillow and Trulio and Dollar Tree and Family Dollar get together, offset discouraging pending home sales for June. More on that in just a moment. At the close, the Dow Industrials were up 22 points to 16,982 and change. The NASDAQ, though, inched lower, falling 4, and the S&P 500 rose fractionally to 1978. But attention now turns to some very important data this week, including the July employment report, our first read on second quarter growth, and a meeting of the Federal Reserve thrown in for good measure. Steve Leisman has more.
The Fed's meeting this week comes amid a slew of important economic data that could influence Fed policy. So for Fed Chair Janet Yellen, the question is whether the numbers will throw a wrench into the current plans to exit gradually from its easy monetary policy, or will inflation, better growth, and more jobs force the Fed to move more quickly?
The risks this week are that the Fed continues its gradual tapering of policy. At the same time, the market becomes ever increasingly worried that the Fed's behind the curve.
Among the big data we get this week, on Wednesday, we'll get the ADP report. The private payroll company tries to estimate the government jobs number. Economists looking for 233,000 private sector jobs to be created. Also, we'll get the first read on second quarter GDP, seen near 3%, almost reversing the first quarter decline of 3%, and GDP prices seen rising about 2%. Friday, we get the payroll report at 234,000. The unemployment rate seen ticking down 0.1% to 6%, and wages seen rising 0.2%. If the data are strong, UBS's Mattis thinks it could start a process that will not see the Fed hike sooner, but hike faster once it starts.
And the real reason is because they are going to be hitting all of their targets with the Fed funds rate at 0 and a balance sheet that's $3 trillion too large. And for us, that math doesn't add up. Something's got to give. If you're trying to tighten policy and you have a balance sheet that supposedly creates stimulus on its own, and that's going to be $3 trillion too high, and the only thing you can move is rates. Rates have to go up faster.
But the consensus in the market is that Yellen won't blink. Only a slight tweak is expected to the Fed's statement on Wednesday to take note of the improving jobs market. But there are likely to be serious behind-the-scenes discussions from some hawks and even a few centrists who want to speed up the pace of tapering and even move up the timetable for hiking interest rates. Yellen is likely to resist calls for moving faster, especially because of the big GDP decline in the first quarter and because of the housing data, which she views as key to the recovery, has been so mixed. But the question is whether the data in the form of higher inflation or better jobs growth forces her hand. For Nightly Business Report, I'm Steve Leisman.
Here to give us some investing guidance for the remainder of the year are Andres Garcia Amaya, global market strategist with JP Morgan Funds, and Barry Bannister. He's a market strategist at Stifel Nicolaus. Welcome, gentlemen. Good to have you with us. Andres, let me begin with you, and let's focus especially on the geopolitical tensions that are around the globe right now. Do they fundamentally change your view of the global economies and markets and what I should do with my money, or do they merely increase short-term volatility?
I think the second option you just provided. I think the fundamentals really come down to how are corporate earnings doing, which rely a lot on the economy here in the United States. And we expect that to continue to accelerate, although at a slower pace than we're accustomed. So yes, the situation in Ukraine could deteriorate. yes, the situation in the Middle East could spike once again, and it could create short-term volatility. But for our viewers that are trying to retire one day, is that going to dramatically change their asset allocation? The answer for me is probably not.
All right, thank you for that, clearing that up. Barry, you have an interesting forecast here. It's one you've stuck with for the year. You think the S&P 500 will dip down this quarter to what? The 1850 level?
Yeah, that would be about right. Obviously, the number one rule since 2009 has been do not fight the Fed. And we were bullish in 2013. But when you look at it, low inflation, low interest rates, cheap wages, and a devalued dollar are largely in the market. And so what you're betting on now is continuity.
So what do you think could trigger it? Or do you think we're already beginning that slow grind lower over the next 60 days?
Well, a post-recession economy is a little like a patient in a hospital. You've got to have a handoff from policy life support to sustainable GDP and credit growth that forestalls deflation. I think it's going to be a rocky handoff, and every time the Fed has let go of the handlebars, so to speak, with QE, we've had some disruption. We'll see how the third quarter goes.
You know, Andres, you are not in Barry's camp. In other words, you're not picking, suggesting that the market may falter by 5 or 6% here. But you do say that you're no longer in love with equities. What's changed?
Yeah, so if you think about what the biggest drivers for equities long-term are, is earnings growth and valuations. Right, last year we were pounding the table saying equities look cheap, and by the way, earnings growth should continue to move up higher. Now, valuations are no longer as attractive. They're not expensive, but they're no longer as attractive. So we're left with one driver, which is earnings growth. So we still like equities, but we don't love them as much as we did before when we had two of the major drivers pushing returns higher.
So really what I hear you saying there, Andres, is watch profit growth, because your capital growth is probably going to be linked very closely to that. The speculative part of your investment return, the valuation, isn't going to help you that much.
Exactly. Now, the last thing that I would add is what are your other options, right? So cash is yielding you nothing, and obviously fixed income could be affected negatively if the Fed decides to raise interest rates sooner than maybe the market expects, which leaves us again with equities as our favorite asset class.
So, Barry, leave me with one idea between now and year end that will either save me money or make me a little money.
Well, it's a long shot, but one of the big things that I've noticed about the market is that as we enter a period where everyone's on one side of the trade, the least expected thing happens. So if real rates go negative, and if growth is a little stronger than expected, and overseas rebounds, and real rates go strongly negative because the Fed's stuck at zero, then you could see the precious metals actually finish the year quite strongly. And year to date, they've done just fine versus stocks.
Andres, let me ask the same sort of question to you. If there's a sort of one idea that you'd like to leave the viewers with to either protect their capital or grow it a little bit for the remainder of 2014, what might it be?
I think European equities have had a tough run the last couple of weeks, but I expect that if the European economy actually picks up growth, you could see significant earnings growth for this year and next year.
All right, gentlemen, thank you very much. We appreciate your help and your insight. Andres Garcia Amaya with JP Morgan Funds, Barry Bannister at Stifel Nicolaus. Thanks again. Well, adding to the economic and diplomatic pressure on Russia, a $50 billion judgment to pay former shareholders in the now defunct Yukos oil company. Remember that one? An international court has ruled on claims that the Russian government illegally seized the company from one of the country's most powerful oligarchs. Yukos became Russia's largest investor-owned oil company after the collapse of the Soviet Union. GML Limited, the holding company, created by Yukos founder Mikhail Khodorkovsky, had asked Russia to pay $103 billion in compensation. The dispute began way back in 2003. Now to those mergers we told you about at the top of the broadcast, where the fight for penny-pinching shoppers is heating up. Dollar Tree announced today that it is buying its rival discount store, Family Dollar, for a lot of dollars, $8.5 billion to be precise. Shares of Family Dollar soared almost 25%, while Dollar Tree gained about 1%. So why is this deal being done? Why now? And what could it mean for the company that dominates the discount space, Walmart? Courtney Reagan has our story.
Some serious money is being spent in the dollar store space. In a surprise move, Dollar Tree is buying Family Dollar for $8.5 billion. The combination will rake in more than $18 billion in annual sales between 13,000 stores in 48 states and Canada. Family Dollar stores will stay under their same banner, with CEO Howard Levine joining the Dollar Tree board and now reporting to Bob Sasser, CEO of the now expanded Dollar Tree. Credit Suisse analyst Edward Kelly says Family Dollar will increase Dollar Tree's earnings by, fittingly, $1 per share, but he doesn't think the deal is the best move for Dollar Tree shareholders and is downgrading his recommendation on the stock. Activist Carl Icahn, who owns 10% of Family Dollar, has been pushing for change. So while a new owner for Family Dollar wasn't unexpected, many are surprised that Dollar Tree, rather than Dollar General, made the offer. Dollar General and Family Dollar's businesses are much more similar. But the deal immediately expands Dollar Tree's reach, albeit with two very different types of dollar stores.
But I do think there's more risk for them to buy Family Dollar than if Dollar General had bought Family Dollar. After all, had it gone the other way, one large competitor would have sort of been removed from the game. Where with Dollar Tree coming in, now we still have three serious competitors: Family Dollar, Dollar General, and Walmart.
But for Walmart, not much changes competitively with the merger. Though the world's largest retailer has acknowledged it's lost some market share to dollar stores over the last few years. As a result, Walmart is rapidly expanding its network of smaller format stores to better compete. The changes shoppers may see: improved product selection at Family Dollar as it comes under a better managed parent company, and possibly lower prices down the road once the scale helps lower overall costs. For Nightly Business Report, I'm Courtney Reagan.
Two of the most popular companies that help people find homes are merging. The real estate website operator Zillow is buying the smaller rival Trulia. The $3.5 billion deal would make the combined company the biggest player in the online real estate marketplace. Shares of Trulia up 15% on the news. Zillow also gained ground today by about 1%. Morgan Brennan takes a look at the potential risks and rewards in this deal.
If you've hunted for a home in the past several years, chances are you started the process online, scrolling through listings on sites like Zillow and Trulia. The two online real estate giants have been competing for nearly a decade. Now, they plan to merge. The deal would create the biggest company by far in the online listing space, trumping competitors like Realtor.com and, to a lesser extent, online brokerage Redfin. Under the Zillow umbrella, Trulia would continue to operate as its own brand, catering to home buyers and renters, while Zillow continues to focus on transactions and markets.
It's very helpful to have multiple brands to appeal to a larger audience, and I think the Trulia brand complements the Zillow brand really well. The overlap stats that we put in the press release, just for example, fewer than half of Trulia's visitors also visit Zillow, and around 2/3 of Zillow visitors don't visit Trulia. So it's a pretty differentiated audience already.
Zillow first approached Trulia about a merger 6 weeks ago. Since then, both boards have approved the acquisition, and experts widely expect the deal to clear regulators. Analysts say it makes sense because the companies have very similar business models. Both are essentially housing-focused media companies, generating the majority of revenue from online advertising.
The combined company is going to have a lot of advantages over the two companies operating independently. There will really only be one platform.
An estimated 90% of Americans now begin their home searches online. Yet Zillow and Trulia's combined revenue is less than 4% of the estimated $12 billion that realtors spend annually on marketing. So experts say there's plenty of room for the company to grow, and it could even streamline the search process for consumers. But there are risks, and one of the largest will be making sure a bigger Zillow can develop stronger relationships with real estate brokers, the biggest advertisers, rather than alienate them. Another issue, the deal could make it even harder for smaller companies to compete in this space. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, how long will funding for Medicare and Social Security last? We have the details coming up. Well, the trustees who oversee the financial health of the government's two largest benefit programs have released their annual report. And there is some positive news for Medicare. The report shows its funding outlook has improved and that the program's hospital trust fund now won't be exhausted until 2030, 4 years later than last year's estimate. Meantime, Social Security's retirement program will remain solvent until 2034, although disability benefits are in more immediate danger.
As today's reports make absolutely clear, Social Security and Medicare are fundamentally secure, and they will remain fundamentally secure in the years ahead. The reports also remind us of something we all understand. We must reform these programs if we want to keep them sound for future generations.
Hampton Pearson is in Washington with more on the report. Hampton, what exactly did we learn today about the state of Medicare and Social Security?
Hi, Tyler. 3 trust funds, 3 different headlines. First, Medicare, the combination of a slowdown in spending on health care, some benefits from the Affordable Care Act, and yes, tax hikes on high-income earners, along with beneficiaries paying more out-of-pocket, all help brighten the picture for Medicare finances. The trustees say that trust fund, as you mentioned, won't be exhausted until 2030, 4 years later than last year's estimate. Now, for the 58 million who are getting Social Security retirement checks, it looks like full benefits are guaranteed until 2034. The only near-term funding problem has to do with the Social Security Disability Trust Fund. It's projected to run dry by 2016, at which point the program will only collect enough payroll taxes to pay out about 81% of benefits. So that's the latest sort of quick checkup, if you will, on the financial health of the government's two largest benefit programs.
So, Hamp, what can be done short-term to fix the disability fund?
Well, Congress can do what it's done in the past, and that's basically shift some of the revenue from the big retirement program or combine the two programs. But if you do that, you shorten the long-term finances by about a year. So 2033 would be the retirement fund deadline, which basically was what the trustees told us was going to happen in their report last year.
Sort of a borrow Peter to pay Paul kind of solution there. Today's report, a little breathing room, I guess. So what are the most compelling numbers for why we need a long-term Social Security and Medicare fix?
Well, here's a couple that kind of jumped off the page for me. So we've got Medicare adding about 10,000 new beneficiaries every day as baby boomers turn 65 and become eligible. And since 2010, Social Security has been paying out in benefits more than it's taking in. Last year, no exception, $823 billion going out the door in benefits, but only $747 billion collected in taxes. And make no mistake about it, Tyler, that trend is expected to accelerate.
All right, Hampton Pearson, thanks very much. The House has just sided with the airline industry in approving a bipartisan legislation that allows the base price of airline tickets to be the most prominent part of an ad. Taxes and fees can be displayed separately, such as in footnotes or pop-up ads. The airlines argued that including the taxes and fees in their advertising prices hurts business, but consumer groups say advertising the pre-tax fare is misleading because that's not what consumers pay. The Business Travel Coalition says taxes make up about 20% of your average $300 total ticket price. So far, there is no Senate version of the bill. Virgin America has filed a flight plan for Wall Street. The small California-based airline is planning an initial public offering of shares that it says could raise as much as $115 million. But analysts say that number is likely to change. There's no word at this point on how many shares will be sold or exactly when. The flamboyant Sir Richard Branson is a part owner of Virgin America. Southwest Airlines may be facing a fine, and that is where we begin tonight's market focus. The Federal Aviation Administration has proposed a $12 million civil penalty against the airline. The agency says Southwest failed to comply with regulations related to repairs of 44 jets. Shares of Southwest off fractionally to $29.21. The engine maker Cummins said second quarter sales were strong, and the company raised its revenue forecast for the full year, citing growing demand in North America as the economy improves. But international sales fell, with weakness seen especially in Mexico, Brazil, and India. And that pressured shares. Cummins down 3% to $145.35. Tough day for shares of Horizon Pharma. The specialty pharmaceutical company said two major pharmacy benefit managers, CVS Caremark and Express Scripts, will place two of its biggest selling drugs on their exclusion list. The exclusion leaves a higher portion of drug costs with patients who don't switch to other, less costly alternatives. Both of the drugs in question treat arthritis. The stock was off 34% to $9.15. Tyson's Food is selling a big chunk of its international operations to a rival to help pay for its acquisition of Hilscher Brands. The meat processor will sell some Latin American chicken operations, leaving China as its only major non-U.S. operation. The company also reported a rise in profit and sales on higher prices and volumes. The stock up more than 2% to $40.56. Smith & Wesson settles SEC bribery charges. The company will pay $2 million for making improper payments to foreign officials as a way to win firearms contracts overseas. The violations occurred between 2007 and 2010. Shares of Smith & Wesson fell fractionally today to $13.57. And Herbalife, the company that's been the target of investor Bill Ackman, reported disappointing earnings after the closing bell. The maker of weight loss and nutritional products reported a 17% drop in its quarterly profit as costs rose. Earnings and revenue both missed analyst expectations. And after the close, shares initially dropped on the report, but they finished the regular session with a 2% gain at $67.48. A lot of that seemingly vaporizing after hours. The chairman and CEO of Darden Restaurants is stepping down. Clarence Otis had come under fire from activist shareholders who criticized his turnaround strategy. Otis will remain on the board until the end of the year or until a successor is found, whichever comes first. Investors did seem to like the news, shares popping after hours, as you see right there. They closed the regular session at $44.92. Argentina will meet Tuesday with a U.S. mediator in its battle with holdout debt investors over talks to avert its second default this century. The news came as the clock ticks down to a Wednesday deadline for Latin America's number 3 economy to either pay the New York hedge fund investors who were suing the country in full or to cut a deal to prevent a default. Failure to do so could mean Argentina won't be able to service exchange bonds accepted by most other creditors at a hefty discount following its last default. Chinese officials have a new target, Microsoft. Officials in that country made an unexpected visit to the tech company's offices. But that's not stopping Microsoft from pushing ahead with its business plans in China. Eunice Yoon has more from Beijing.
Microsoft has confirmed that Chinese government officials have made sudden visits to their offices in cities across China. Chinese media are reporting that officers from the State Administration for Industry and Commerce visited the U.S. software giant in Beijing, Shanghai, Guangzhou, and Chengdu. A Microsoft spokesperson issued a statement saying that the company is happy to answer the government's questions. No word, though, on the reasons for the inspections, but the visits come when American tech companies have come under pressure here after the U.S. accused Chinese military officers of cyber theft. Microsoft is still pushing into the China market. Its Xbox game console goes on sale in September for the first time in China this year after the government lifted a decades-long ban on consoles. Chinese can now pre-order their machines through NASDAQ-listed e-commerce site JD.com as well as local social media company Tencent. Microsoft says that it will hold a product lunch in Shanghai this Wednesday, and later in the week, Chinese gamers can get a better feel for the Xbox when they test out the console at a gaming conference in China on Thursday.
For Nightly Business Report, I'm Eunice Yoon in Beijing.
Coming up, ever try to change your cell phone carrier only to run into unexpected snags? Why, that may soon be a thing of the past. There is some good news for people heading by car to their summer vacation destinations. Gasoline prices have fallen sharply over the past 2 weeks. The Lundberg survey shows they're down by an average of 9 cents in that time to $3.58 per gallon for regular. And finally tonight, President Obama says he is looking forward to signing into law a just-approved bill that gives mobile phone users the right to unlock their devices and then use them on competitors' wireless networks. More from Josh Lipton on what this all means for consumers.
You're getting a quick overview of all of your activities.
Your phone is free again. The House of Representatives passed a bill on Friday that lets consumers unlock their mobile devices in order to use them on competitors' wireless networks. The president says he looks forward to signing the bill, which has already cleared the Senate and reverses a 2012 decision by the U.S. Copyright Office. So why does it all matter? Well, because right now, most mobile phones in the U.S. are tied to a particular network, sold by carriers at big discounts when consumers sign long-term phone contracts. So when those contracts expire, customers wanting to keep their phones but change networks first have to get permission from their carrier or face legal ramifications. The new bill eliminates that. Also, unlocking phones gives them a second life, making them cheaper options for customers who can't afford new phones with expensive wireless plans, and potentially keeps phones from ending up in landfills. In December, the FCC announced a voluntary agreement with the major wireless carriers that made it easier for consumers to free up their phones, but consumer rights groups say the current bill takes it a step further. And while it's unclear what the immediate impact of the law will be on the industry, a trade group representing smaller providers hailed the move as a victory for smaller carriers and consumers alike. For Nightly Business Report, I'm Josh Lipton in San Jose.
And that's Nightly Business Report for tonight. I'm Tyler Matheson. We'll see you right back here tomorrow night. I'm Tyler Matheson with a Nightly Business Report News Brief. Stocks turned higher in afternoon trading after being lower earlier in the day. The Dow rose 22, the Nasdaq fell 4.5. The S&P was up a fraction. Dollar Tree is buying rival discount chain Family Dollar stores in a deal valued at about $8.5 billion. This gives Dollar Tree a step up in the intensifying fight for penny-pinching shoppers. And Zillow is paying $3.5 billion for the online real estate firm Trulia. The combined company will be the biggest player in the online real estate market. And a new report shows Medicare funding will last until 2030, 4 years later than last year's estimate. Social Security will be solvent until 2034, but disability benefits could run out as soon as 2016. Be sure to tune in to Nightly Business Report here on your public television station.